It's Michael Douville. I'm here in Phoenix, Arizona. It's February 10th, 2015. I have a couple of thoughts I'd like to just discuss today. Before we get going, I do need to have a disclaimer saying I'm not a licensed financial advisor, nor a real estate attorney, nor a licensed stockbroker. I represent a lot of investors here. I'm an investor myself. We own properties. We recommend properties. I'm an advocate for an awful lot of investors, and we try to do what's prudent. So we always try and watch the economy as to what may or may not be going on, what direction the economy is. We're so economically sensitive, just like any other industry. And we watched the news, and in the news was Jim Clifton. Here he was with Gallup polls. He wrote on his blog the other day, called it the big lie. He was talking about the unemployment rate in the United States being 5.8%. And he thought that the employment rate was pretty drastically understated, and said it didn't accurately portray what the employment picture in the United States truly was, and he thought that the unemployment rate was much higher than 5.8%, maybe over 10. So some people say 11.2%. So that's a huge difference between 5.8 and 11.2%. And I guess the problem comes in is what's being stated, what's not being stated, who is employed and who's not employed. He was saying that we're down to 44% of working population has a full-time job. 44%. It's the worst we've ever had. It's terrible. And they're calling a full-time job 30 hours a week, down from just recently down from 33. When I was a kid, it was 40 hours. You work 40 hours a week. You work Monday through Friday, and half a day on Saturday. You get overtime. So virtually everybody was working 40 hours a week. And here we are, we're calling classifying a full-time as 30 hours a week. When you have 44% of the population having a full-time job, it does not bode well for a robust economy. You couple that with a historical high. I think it's over 50 million people are on food stamps. So if you're on food stamps and you've got historically high people on food stamps and historically low amount of people having full-time jobs, I don't see how you can have a robust economy. It really concerns me. And I'm looking for clarity on these. So we really look at the statistics, and we're dependent on the government to tell us what is truly going on. Just the other day, the Bureau of Labor Statistics came out and they said 5.8% unemployment. Well, that's great. Sounds really, really wonderful. And then I hear later on that the oil patch workers, and we've lost a lot of oil patch workers. A lot of people have been laid off. All these oil rig drillers and support staff and the service people and everyone that's associated with this have lost. They've lost a lot of jobs. So in order to keep the employment rate low, they classify these people as seasonally adjusted. So therefore, they didn't have the impact on the employment rate. Now, to me, it's really playing games with the numbers. If it's bad, I'd like to know that it's bad. If it's good, I'd like to know if it's good. There becomes a feeling of trust, and we really need to be able to trust the government to tell us really what's going on. That's not only the government. I've been looking at PE ratios for our stock indices, and whenever we get into a S&P has a PE ratio around 20, why the economy seems to start getting into trouble, starts rolling over. It's just a business cycle. We go through business cycles all the time. This is just a reality of life. So I look at the PE ratio, and the PE ratio is 17.5. Well, when you start looking at that, you find out that 17.5 is a non-GAAP earnings. And if you go into GAAP earnings, it's like 19.8%, and we haven't had this year. Haven't had 2015. We're still in fourth quarter of 2014, and we're decelerating now. So we could very well have GAAP, which is generally accepted accounting principle earnings, over a PE ratio of 20. Now, generally accepted accounting principles means that you have clarity, you have visibility. You can look at an accounting and know what goes in and what goes out, what the profits are, what their losses are. It's pretty, and you can compare that from one industry to the next industry. You can compare that from one business to the next business. They're generally accepted accounting principles. Non-GAAP gives some flexibility. You can adjust the earnings. You can decide when to take a loss. You can put the loss in after you show the earnings, so that if you show high earnings and then the next week you report the loss, why your non-GAAP is much higher because you didn't report the loss. You have flexibility. You can call tangibles and intangibles. So if you have some intangible assets, you can include those in your non-GAAP. What's an intangible asset? Is that like goodwill? So who values these? So non-GAAP is sometimes fictitious, and this is where an awful lot of companies get themselves into trouble with this. And I've noticed that a lot of companies are using non-GAAP. I just looked at the NASDAQ earnings per share for 2014 are out. So in the NASDAQ, earnings per share, non-GAAP, is 75 cents per share for earnings, non-GAAP. But if you look at GAAP, generally accepted accounting principles, it's down to 50 cents per share. Well, let me tell you, there's a huge difference between 75 cents a share and 50 cents a share. That's 25 cents. 25 cents on 50 cents is 50%. A 50% difference in profit. So that's just huge. So you can understand where a company would want to state it in GAAP or in non-GAAP, so that they can make their earnings look so much better because they get paid on earnings. And the other thing I've noticed, and this has been in the news too, is that a lot of companies are taking advantage of the low interest rates and taking bonds and taking long-term debt. Good business if you can get cheap money, long-term. Why wouldn't you take that? But they're not putting into capital expenditures, not CapEx. It's going into purchasing a lot of their shares. So instead of increasing their business and increasing their top-line growth, what they're doing is decreasing their amount of shares, so that increases the bottom line. So that makes it so much more beneficial. They get a pop on the earnings because there's fewer shares to divide the earnings by. That's not a good sign. You want companies that are so involved in their business that they're excited with it. They got CapEx. They're building more plants. They're doing more things. They're expanding, not just buying back their shares. So that also is kind of a little bit of a trickery. And why is that important for us if we're in the real estate business? Because we're economically sensitive. We're slow. I mean, you can't just pick up the phone and call and sell our shares. At 9 o'clock you place the order in. At 10 o'clock, everything's done. That doesn't happen in my business. When we sell a commercial building, it could take 30 days, could take 6 months. Same with a house. Could be a long time before you sell a home. And we make our money being in front of trends. Now, our trend has been really, really well, and we make our money being trend followers, and we're a leveraged industry for the most part, particularly when we have these interest rates at such historically favorable levels. Why wouldn't you be taking leverage? So it only takes 20% to buy a property. We generally buy them pretty well. We try and pride ourselves on getting as good a price of property as we possibly can. We put 20% down. Now, we've had a growth rate here in Phoenix that started at, I think the Cromford report just came out, was 13%. I'm coming off my memory, but I think it was 13% annualized rate in January 2014. Well, it's down in November to 0.16%, less than 2% annualized. So that's pretty big drops, and it's pretty straight lines. So we know that we're decelerating here. And when I sit down with an investor, we try and plug in a very conservative appreciation rate, typically about 3%. And we've enjoyed a 3% compounded rate here for a very long time. So let me just use that. So if we have a $200,000, just a little investment property we buy for a rental for $200,000, you require to put 20% down. So that's $40,000. If you get a 3% appreciation rate, that's $6,000 on an initial $40,000 down payment, it's a 15% appreciation. How nice is that? You get a 15% capital gain, excluding cash flow. And we're all about income. And that's excluding any tax benefits that you may have. It's also excluding any principal reduction that we get. So a 15% base rate to start, gosh, that's really nice. It really drives our business. This is how wealth is generated. we get in front of these trends, and we just go with them. So it's really important for us to know what the trend is. Our trend here is decelerating. Now, is this just a blip? Don't know. But when it starts to decelerate and you start looking around the world and seeing that China just missed hugely, that China is taking a lot less oil, and their oil imports has dropped 50%. So is that people are saying, well, are oil prices down because they're pumping so much, or is it because demand dropped? Well, look at if China is importing 50% less oil. Well, I got to tell you, it might be a little bit of both, but if the demand is off, that means that the economy is off. China's a big driver. You can't say that Europe's doing well. Russia's looking for a recession. Greece certainly in a recession. Portugal in a recession. Spain in a recession. Italy in a recession. You look around the world, things are not as good as they can be. And we have an appreciation rate that's decelerating. So we're just a little bit cautious. And we have the government telling us, that things are better than what we think they are, really causes us to be concerned. So what I'm advocating, and I have been advocating for the last year and a half, is to look at your portfolio. Do you have some things in there that you say, I don't know if I should have them or not? They're marginal. Are these good properties or bad property? If you can't make up your mind, if you can't put it in the good column, it's probably a marginal property. If it's a marginal property, you need to sell it. And if you have any properties that are free and clear, or have old loans on them, you might think of refinancing. I'd be very conservative with the refinance. You can get historically low interest rates, so why wouldn't you do that? So I would take no more than 65%, and I would certainly leave a cash flow component in any property that you refinanced, or anything that was cash flowing. You want to make sure it's still cash flowing, and see if you can't keep that cash somewhere. Because I think if I'm right and things do start to slow down, then what I would say is we're probably going to have one of the best buying opportunities we've ever had in our life coming. Because I am so bullish 4 or 5 years out. I just see nothing but good things. So it's just between getting there from here to there. We'll have some purchases of opportunity that will come along that are just so compelling we want to buy them, and we want to have the cash to do that. So anything that's marginal, you need to sell. Anything that has a huge equity position, I would encumber up to about 65%. Any questions you have, you can always contact me here. I mean, you guys always call me, so you can call me here at 480-451-9339, and you can get me on my email. And it's my name, first and last name, at realtyexecutives.com. So it's Michael, Michael, Douville, Douville, at realtyexecutives.com. Call me, we can discuss this further, but I think we need to be just a little cautious at this point. My very best to you all.